Hi everyone, and thank you for joining us today for our portfolio construction webinar, part of our series designed to help you see wealth differently and spot new investment opportunities. My name's Liam and I'm from the marketing team here at Netwealth, and today we have the pleasure of having Sarah Shaw join us from 4D Infrastructure. With the middle class growing every day in emerging markets, Sarah will be sharing what investment opportunities this changing demographic is resulting in. But before we get into the good stuff, let me just run through some quick housekeeping items. Firstly, for financial advisors joining us today, there is one CPD point allocated for joining this webinar. To receive this point, you will need to be online and in the session for at least 30 minutes. You'll then receive your CPD details via email within the next week. For everyone, this webinar is being recorded and you will all receive a copy of this email within the same, of this recording within the same email within the week as well. And you'll notice that in your taskbar to the right, there's a little questions panel. We encourage you to ask any questions you have for Sarah and we'll endeavour to get through as many as we can at the end of her presentation. Please be aware that the information shared today is general advice only and is not intended to be professional financial advice, and that today's webinar guest is a product issuer on Netwealth's platform. A little bit about us. We're an ASX listed company in our 20th year, and our purpose is to help Australians see wealth differently and discover a brighter future. We provide investors with a range of investment and super solutions via a platform, including the ability to manage your super investments using our portfolio tools, access a range of reports and online charts to analyze their portfolio, and to stay up to date with changes in the market by accessing live prices and charts on individual stocks. Our platform also supports financial advisors with a range of financial products and services to help manage their clients' investments and super. Now on to our speaker. As mentioned, we're delighted to have Sarah Shaw here today. She is the Global Portfolio Manager and Chief Investment Officer at 4D Infrastructure. Sarah has over 25 years finance experience, including 15 years global listed infrastructure experience. She has particular expertise in emerging markets, having followed the region since 1998, combined with regional experience across developed Asia, Europe, and the USA. So without further ado, Sarah, please take it away.
Good afternoon, and thank you for the opportunity to introduce you all to 4D and the infrastructure opportunity set. As mentioned, I run a dedicated global listed infrastructure fund. Infrastructure is known as a defensive asset class. It is. I like that about it. However, today I hope to explain why infrastructure is much more than a defensive allocation, and why I'm excited about the infrastructure growth opportunity for 2020 and well beyond. I believe that the combination of infrastructure's defensive attributes, coupled with a huge and growing need for infrastructure investment globally, and the diverse nature of assets within the infrastructure universe, will see infrastructure as an asset class as a fantastic investment opportunity for years to come. With active management, an infrastructure portfolio can be positioned to take advantage of the long-term structural growth opportunity, as well as whatever cyclical events 2020 and the future throws at us, whether they be economic, political, or environmental. Today, I plan to touch on each of these three drivers of performance, with a focus on the longer-term demographic trends supporting the infrastructure growth opportunity. In particular, I want to focus on the emergence of the middle class, predominantly in developing economies, which is a theme that I believe will provide enormous opportunity for investors going forward. I will follow this with some historical data points to support the infrastructure thesis. I will then make some comments on our current economic outlook, where we see the near-term risk, and how to position for both the opportunity and the risk. As a result, I hope you gain an understanding of the key infrastructure thematics we believe will offer investors significant opportunity for decades to come. But first, very briefly, what is infrastructure? Put simply, infrastructure provides basic services essential for communities to function and for economies to prosper or grow. For 4D, this equates to the publicly listed owners and operators of essential services. These are your regulated utilities in the gas, power, and water space, how we turn on lights or get the taps running, and user pay assets. User pay being toll roads, airports, rails, port operators, where the user pays for the service. These assets are all characterized by monopolistic market positions or ones with high barriers to entry. Their returns are underpinned by regulation or contract. They have a high upfront capital investment followed by very low maintenance spend, a largely fixed operating cost base, inflation hedges, pretty much everything that comes together to give you the long-term resilient and visible cash flows which underpin a yield or a potential yield. Because of these characteristics, infrastructure is known as a defensive asset class with lower volatility of earnings and higher yields than broader equities. That is pretty well understood, and as an investor, I love these defensive characteristics. However, infrastructure offers this defensiveness with significant potential growth upside as a result of the huge and growing need for infrastructure investment globally. By 2030, the B20, which is the business arm of the G20, estimate that an additional 60 to 70 trillion US dollars of infrastructure capacity will be needed globally. This amount grows to $94 trillion by 2040, according to industry body the Global Infrastructure Hub. This is a result of decades of underinvestment and changing dynamics of the global population. To touch on each of these, there has been a chronic underspend on critical infrastructure in virtually every nation over the past 30 years, if not longer. To put this in context, over 50% of London's water mains are over 100 years old. 1 in 3 railway bridges in Germany are over 100 years old. The 2018 Genoa bridge collapse in Italy has highlighted the age of much of the European transport infrastructure. It was a mere 51 years old. In America, the average age of a bridge is 42 years old, and we are starting to see the older ones crumble. Also in America, close to 80% of the water pipes are over 30 years old, and some are over 100 years old. We are talking about wooden water pipes still being used by the global superpower to service their community's water needs. These photos on your slide in front of you are all examples of developed market infrastructure in dire need of investment. The second driver of the need for infrastructure investment is quite simply population growth. In 1900, the global population was 1.65 billion people. By 2000, that number had grown to close to 6.1 billion. Keeping in mind that some of the infrastructure we're still using today was built to service that 1.65 billion. By the turn of the next century, the global population is expected to be over 11 billion, underpinning yet even more spend. We first need to play catch up, and then we need to invest for the future generations. Importantly, much of this population growth is coming from the emerging world, where demographic trends are very supportive of economic evolution and infrastructure investment, as I will discuss shortly. Before doing that, however, as an aside, I will just note that this population growth has also raised a number of environmental and climatic challenges, which underpin the need for even more spend on infrastructure to ensure the sustainability of this planet we currently rely on. To that end, renewable energy and the coal to gas transition are thematics we are currently investing in. The final driver of infrastructure investment needs, and the one I want to focus in on today, is the emergence of the middle class in developing economies, which is supporting both the emerging market domestic demand story, but also the demand for global infrastructure. Emerging market economies are expected to grow rapidly over the next 30 years, altering the current world economic order, which has been in place for much of the post-World War II era. This growth will be driven by an expanding middle class. Given the potential size of the middle class in emerging markets, China, India, and Indonesia alone account for 40% of the global population. Changes in spending and consumption patterns will have significant implications for global business opportunities and investment for decades to come. Looking at it from an individual's perspective, as personal wealth increases, consumption patterns inevitably change. This starts with a desire for 3 meals a day, moves to a demand for basic essential services such as clean water, indoor plumbing, gas for cooking, heating, power. This all requires infrastructure. With power comes a demand for a fridge or a TV, which increases the need for port capacity and logistics chains. This is again infrastructure. It progresses over time to include services that support efficiency and a better quality of life, such as travel, with an increasing demand for quality roads to drive that new scooter or new car on, and airports to expand horizons. Importantly, one of the clear and early winners of this growth in the middle class is infrastructure, which is needed to support the evolution. At present, less than 10% of the Chinese population has a passport. It's less than 5% in India. And yet airports globally are reporting record passengers driven by the Chinese tourist. Tourism Australia forecasts that by 2025, Australia will receive 3.2 million inbound Chinese visitors a year, up from 1 million today. This will represent 26% of the total inbound visitor market in that year. And we are just a drop in the ocean. At the World Economic Forum in Davos earlier this year, the CEO of Chinese travel provider Ctrip predicted the number of Chinese passport holders would grow to 240 million by 2020, next year, up from around 120 million today, or just 8.7% of the population. And this is just the start. Taking China, India, and Indonesia as an example, China will displace the US as the world's largest aviation market, defined by traffic to, from, and within the country around 2024. India will displace the UK for 3rd place in 2025, and in the same year, Indonesia will enter the top 10 at the expense of Italy. Over the past decade, the developing world's share of total air passenger traffic has risen from 24% to over 40%, with the trend set to continue. A further example of the impact of the expanding middle class is the natural correlation between growth in GDP per capita and vehicle ownership. Emerging markets in general still have a relatively low level of motor vehicle penetration. However, as each nation's GDP per capita grows, it is expected that so too will each country's level of vehicle ownership, which equates to the need for more roads. Just over 10% of Chinese own a car, but since 2010, annual motor vehicle sales have been well above the USA, where motor vehicle penetration is over 70%. As an infrastructure investor, I don't care if you're driving a 30-year-old Ford Fiesta or a brand new Porsche, as long as you're driving it on my road. I've talked a lot about China, but this opportunity set is not confined to China. India is probably 5, maximum 10 years behind China in this evolution, and Indonesia a little behind that. Mexico is also benefiting significantly from an expanding middle class, as reflected by double-digit domestic air passenger growth. Even the smaller countries are benefiting. Vietnamese GDP rose 7.3% year-on-year in the 3rd quarter of this year, and is proven to be a poster child in emerging markets as to why infrastructure spend is good for an emerging middle class, while an emerging middle class is good for infrastructure spend. Vietnam has a very young and growing middle class. It has a horde of free trade agreements and a booming manufacturing industry. But is starting to see expectations outrun reality. Businesses are complaining about congested ports and roads. Infrastructure is the big challenge, especially at its ports, and is garnering a lot of attention and increased investment. And infrastructure can capitalize on this changing demographic through direct investment within the emerging markets, by way of utility and transport exposure, as well as through global investment by way of new and expanded airports, port and rail infrastructure, and utility services more generally. As an aside, this emergence of the middle class is one of the key reasons I support global exposure in any infrastructure portfolio. I truly believe that the emerging markets are just too important to continue to ignore in global allocations, as they offer an attractive risk-reward profile directly linked to domestic demand and the evolution of the middle class. Emerging markets will be a key global growth engine for decades to come. The evolution of their economies will have a significant impact on global growth profiles. And as these pictures show you on the screen at the moment, they have superior infrastructure. But the complementary nature of emerging market economic growth and infrastructure investment goes further. It offers investors access to the domestic demand story while mitigating some key emerging market investment risks, thus presenting a very attractive way to gain overall emerging market exposure. Let me just be clear, risk is not confined to emerging markets. And to be honest, some key concerns of mine at the moment are coming from the developed world. We have Brexit, we've got Trump, we're having problems in Italy, France, Hong Kong. However, if you focus in on the emerging markets, there are certain risks that can be mitigated by infrastructure investment. A number are listed on this slide, but to focus in on 3. Firstly, inflation. Look for the hedge. A core concern for emerging markets over the medium term is domestic growth-driven inflationary spikes. These are often driven by a weather event, such as that disrupts food sources or fuel supplies. The infrastructure asset class provides investors access to the upside of the growth story while explicitly hedging against inflationary pressure, with regulation and contracts providing an inflation hedge. This mitigates one of the key emerging market investment risks. Secondly, beware of the benchmarks. When looking for emerging market exposure, an investor needs to make sure they are actually getting emerging market exposure. Investors seeking access to the emerging market domestic growth story should be wary of the constituents of the emerging market indices. While some stocks are listed in a developing country, they may have underlying earnings driver not correlated to the domestic growth, but rather global demand. Taking Taiwan Semiconductors as an example, it is listed in Taiwan. It makes up 4% of the MSCI EM index in September 2019 and was the 3rd largest index weight. And in 2018, 80% of revenues came from the developed markets, 64% from the Americas alone, while less than 10% were derived domestically in Taiwan. So even though it represents a major component of the emerging market index, an investment in Taiwan Semiconductors is providing only very modest emerging market economic exposure. In sharp contrast, emerging market infrastructure investment provides exposure directly correlated to in-country domestic demand. Thirdly, local governments are supportive of infrastructure development. Emerging market governments and policymakers recognize the need for improved infrastructure to enable their economies to evolve. As they cannot facilitate all the investment needed, they are supportive of private investment in infrastructure assets to provide the essential services needed to facilitate economic growth and deliver improved living standards. While emerging market governments continue to need private sector capital, investors should have confidence that acceptable investment returns will be supported. When they no longer need your investment dollar, then get out. But that's certainly not going to be in my lifetime, given the need for infrastructure capital today. When you put all these factors together, being the developed market replacement spend, population growth largely driven by the emerging markets, and the emergence of the middle class in emerging markets, the need for global infrastructure investment over coming decades is clear. What is also clear is that the traditional providers of the infrastructure, be that government, are simply not going to be able to fully fund this need, thereby creating this huge investment opportunity for the private sector over the coming years. That is an opportunity, is a key thematic investors can gain exposure to. Just before I get onto some historical data supporting this thesis and also our outlook, I just wanted to quickly touch on the asset diversity within the infrastructure sector, that 3rd driver of outperformance. Despite infrastructure assets sharing the defensive characteristics discussed, the diversity of subsector and region offers opportunity to actively manage your portfolio for all points of the economic or market cycle. The infrastructure asset class offers two distinct and economically diverse subsectors. On the one hand, you have your essential services. These are your regulated utilities in the power and water space. These assets are largely immune to economic shifts, up or down, as a function of them being a basic need, as well as the structure of their regulatory environment, which measures returns independent of volumes. These are the assets that are more bond proxy in nature, particularly over the shorter term. They are an attractive overweight investment in depressed economic environments, as they will offer earnings growth and yield support even in weak growth environments. By contrast, user pay assets such as toll roads, rails, airports and ports should not be considered a bond proxy, as earnings are directly linked to growth but with inflation protection. Earnings from these assets are not fixed, as is a common belief, but rather have a strong positive correlation with GDP growth and inflation. These assets are well suited to growth environments. Active management of these two infrastructure subsectors aims to smooth the volatility of equity investment and market cycles. So our belief is that these three factors combined mean global listed infrastructure offers an attractive investment opportunity for decades to come. It offers defensiveness with huge growth upside and can be positioned to take advantage of all points of the market or economic cycle. The defensiveness can offer a safe haven in falling markets, shift portfolio overweights to defensive markets, go overweight regulated utilities where earnings are protected. You're supported by sustainable, attractive income yields, and you've got a lower correlation to general equities. Yet, infrastructure can still participate in rising equity markets. User pay assets are directly positively correlated to GDP growth. You can position even a defensive asset class for growth, overweight for emerging markets, overweight those assets capitalizing on a significant growth opportunity, and you access the growth with an inflation hedge. And history supports the thesis. We have no doubt all been taught and experienced that past performance is no guarantee of future performance. However, I do think it is relevant to note that since global listed infrastructure has been recognized as its own asset class, it has offered investors better returns than general equities. And this is since 2003. So a period of boom and bust, including the debt-driven global financial crisis. Now, I've just noticed on that slide that that orange line does not have a label. That is the MSCI World. So you've got two infrastructure indices, which is the blue and the yellow, and the orange line is the MSCI World Index. So you can see the outperformance of infrastructure. Now, I believe this outperformance is a result of the factors just discussed, and hopefully will be illustrated a little further in the following few slides. Global listed infrastructure has been defensive over the cycle. By that, I mean in market down months, infrastructure has been down less than general equities. And by contrast, in up months, infrastructure has been up less than general equities. This is as you would expect of the asset class. However, the swing factor has been in relatively neutral months of plus or minus 2%, where infrastructure outperformed to see outperformance over the entire cycle. And it has offered these attractive returns at lower volatility than the broader market. Over the long term, as depicted in this chart, which is from 2003 to 2019, and that's annualized returns on the left and volatility on the bottom axis. And it's also been throughout the cycle. Now, I know this chart is massive, but what each of these data points is representing monthly return volatility of infrastructure relative to general global equities. You will see that the blue box, which is our infrastructure universe, has never given you 3-year negative returns, unlike general equities. Also importantly, emerging market infrastructure has been an incredibly attractive way for investors to gain overall emerging market exposure, as depicted in the following few charts. Emerging market infrastructure has exhibited the defensiveness of the infrastructure asset class. You can see that here with the down months and the up months and the neutral months. Again, it has outperformed over the cycle. And this chart shows that both emerging market infrastructure and general emerging market exposure has offered investors higher return at higher volatility than global equities, as would be expected. But more importantly, emerging market infrastructure has offered investors higher returns at lower volatility than general emerging market equities. And I believe this is because of that direct correlation to domestic demand and the emergence of the middle class. This slide will show you the tightness of the return profile of emerging market infrastructure relative to both the MSCI emerging market index, which has been much greater volatility in returns. The infrastructure outperformance globally and within the EMs has been supported by the resilience in earnings that are mentioned as a key characteristic. This chart shows infrastructure earnings momentum remain positive through both boom and bust economic environments, while general equities suffered some significant hits. It's been supported by that higher yields than broader equities, rewarding investors with an annual yield of 3 to 5.5% over the cycle and an average of 4.3% across the cycle, which is attractive relative to broader equities' 2.7%. It has been supported by the strong growth in the sector, with new assets and new companies coming to the market, and so much more needs to be done. I also believe this performance has been supported by sector and regional diversity. The user pays have driven returns in buoyant markets, while the regulated utilities have offered downside protection in weak environments. So what are we expecting for the next 12 months? While not as buoyant as the last few years, we are not that pessimistic on the global outlook. We see US and global economic growth slowing, but we do not believe a US recession is imminent. We recognize the 10-year, 2-year US yield curve inverted in August 2019 for the first time since 2007. And I just want to make a couple of comments on this. The US yield curve inversion has preceded every US recession over the past 45 years. It is a good indicator. However, not every yield curve inversion has been followed by a recession. And even when inversion did lead to a recession, there has often been a significant time lag between the two. And in that time lag, equities have risen an average 15 to 16% in the 18 months following an inversion, with a range of -11 to +30%. So why don't we believe a US recession is imminent? The US economy is slowing, but data still suggests growth. Unemployment is below 4% and the consumer remains strong. There are still triggers to be pulled. Falling interest rates and monetary policy easing globally should provide a stimulus. The recent yield curve flattening may also be attributable to quantitative easing, or QE, which has distorted the long end of the curve. The US Fed's balance sheet is still many times its size in past cycles, while QE in other countries has probably boosted demand for US treasuries. We believe the inversion is also a result of a flight to quality, given global political overhangs, with global investors looking to take refuge in US treasuries. As Eurozone and Japanese government bond yields are negative, there are few alternatives to US treasuries. Other recession signals, such as corporate credit spreads, remain unstressed. And we believe a US-China trade deal will be done. So with that as a backdrop, we believe an environment where global growth remains positive, inflation is ticking up modestly, and previous expectations of rising interest rates are tempered, will be very conducive for infrastructure assets to perform well. Also, it will be supportive of an emerging market recovery as the threat of those economies of forced rate hikes in line with the Fed is mitigated. I will comment that mid-last year, the emerging markets were sold off as the US Fed increased interest rates, with many believing the emerging markets would be forced to follow suit at the detriment to the domestic growth profile. However, with the exception of a marginal few, such as Turkey and Argentina, the balance sheets of the emerging market countries were strong enough to withstand the US Fed rate hikes without forced domestic hikes. Strong underlying economic fundamentals supported ongoing economic growth. This is a big shift from historical rate hike scenarios. However, let's not ignore the risks. Listed infrastructure is an equity and will move with markets, just with lower correlation. So where is the risk? There has been no shortage of headlines and proposed policy that could potentially disrupt our expected outlook, at least in the short term. It's important to maintain a focus on the world, publicized prevailing economic issues, such as the direction of US interest rates, potential for US Fed policy error, global growth, inflation, US trade wars, and Brexit. However, we believe the biggest threat to global markets at the moment is increasing geopolitical risk and the rise of populism. What is populism? One definition that resonated with us is that populism is an ideology which pits a virtuous and homogeneous people against a set of elites and dangerous others. It can and is coming from both the left and right in political spectrum and is evident in many of the geopolitical issues dominating at the moment. The influence of President Trump, Brexit, the new Italian coalition government, AMLO's election in Mexico, and France's Yellow Vest protests, to name a few. To put it in perspective, 68% of G20 GDP is currently controlled by a populist government or non-democratic regime. This is up from 33% in 2016. What is also becoming evident is that while populist political policies can work in getting a candidate or party elected, they are often very difficult to implement, as they are either incredibly divisive, such as Brexit, or run into the normal fiscal and monetary hurdles of government, such as the battles the Italian government had with the EU in managing their fiscal position, with the EU successfully demanding greater austerity, often the mortal enemy of the populist government. What does this all mean for infrastructure and equities more generally? Populism creates an environment where poor or ill-defined public policy is developed and attempted to be implemented, which is detrimental for not only asset markets, but society in general. This is a major concern for 2020 and beyond, and something we are monitoring very closely on a global and regional level. So what are we watching? We've got ongoing US political chaos and unpredictability. We've got trade wars ongoing. We've got the potential for Brexit to turn into an even bigger debacle, leading to a significant and prolonged UK slowdown. We've got sustained riots in Hong Kong with no agenda or clear objective, and the increased potential for Chinese military intervention. We have conflict in the South China Sea. We have conflict on the Korean Peninsula. We have conflict in the Middle East. And we've got weak governments globally trying to manage all this. For us at 4D as infrastructure investors, geopolitical risk is one part of our analysis and has driven some country downgrades, leading to reduced portfolio positions. But more importantly, in terms of infrastructure, we focus on the strength of the judiciary in that country. When looking at long-dated assets such as infrastructure, governments and government policy will come and go, but we need the judiciary in that jurisdiction to be stable throughout, to uphold the sanctity of contract and regulation in place. If we have that, then as infrastructure investors, we remain confident in our long-term infrastructure fundamentals. I think it is also interesting to note here that we believe one of the strongest judiciaries in the world is an emerging market, namely Brazil, which tends to surprise quite a few people. So how is 4D capitalizing on the infrastructure opportunity? 4D is a truly global, index agnostic, active manager of the global listed infrastructure asset class. Our philosophy is quite simply to get access to the best opportunities globally within the listed infrastructure space for whatever point of the market or economic cycle we are in. So there's a lot in that statement. So just to break it down a little, we are global. We look at both the developed markets and the emerging markets and believe they are both important for the reasons discussed today. We may not always be invested in emerging markets, but we will always have the option to capitalize on both the developed and emerging market opportunity set, and we'll always understand what is happening in those markets, whether invested there or not. We are index agnostic. We don't believe in index relative investing. We think you should be looking for the best ideas globally, not the relatively best considering size or country. And we are actively managing these investment decisions. We believe active management is crucial, so you can position an infrastructure portfolio to take advantage of the long-term infrastructure thematics, being sector growth, the emergence of the middle class, environmental transition, as well as whatever cyclical events 2020 in the future throws at us, whether they be economic, political, or environmental. In terms of thematics that we 4D find particularly interesting, I would highlight the global need for infrastructure investment, which we've discussed today. The emergence of the middle class offers a huge opportunity, as discussed, with infrastructure both a driver and a first beneficiary of improved living standards. The global population growth, but with changing demographics. The West is getting older, but much of the East younger. Renewables. This population growth has raised environmental and climate challenges which underpin even more infrastructure spend. And China's One Belt, One Road strategy, which will see significant investment globally. Just before wrapping up, let me make a couple of comments on China's One Belt, One Road strategy. What is it? What does it mean for infrastructure investment? And where are we? 4D have written a white paper on the One Belt, One Road strategy, which is available on our website. But just to repeat the introduction of that paper for you today, if the president of the world's most populous nation, with the second largest and one of the fastest growing economies, invites you to a huge economic growth party to reshape Asia that he will host and fund, and which he personally described as the project of the century that will add splendor to human civilization, would you attend? Well, that is exactly what China's President Xi Jinping has done. The new Silk Road, or more accurately, China's One Belt, One Road, received a flurry of media attention following a special Belt and Road Initiative, or BRI for short, forum held in China in mid-2017. So what is it? The BRI is a foreign policy and economic strategy of China. The term derives from the overland Silk Road economic belt and the 21st century maritime Silk Road, concepts introduced by President Xi in 2013. There are the two major axes along which China proposes to economically link Europe to China through countries across Eurasia and the Indian Ocean. The BRI also links to Africa and Oceania. The overland belt involves the creation of an economic and trade corridor extending from China's east through Central Asia and finally to Europe. The Belt Initiative calls for the integration of the Eurasian landmass into a cohesive economic trade area. You can see the route in that orange line. For the Maritime Road, China's development of ports and hubs across the Indo-Pacific is a key aspect of the initiative. Purchase and construction of port facilities and associated economic zones in Australia, Malaysia, Indonesia, Bangladesh, Sri Lanka, Myanmar, Pakistan, Kenya, Oman, Turkey, and Djibouti as a start are intended to provide China with maritime access and economic benefit across the Indian Ocean. What does it mean for infrastructure investment? Formally, the BRI emphasises 5 key areas of international cooperation. However, it is the huge investment in infrastructure needed to facilitate the BRI trade objectives which have received most attention. While the quoted numbers tend to vary, in broad terms, China is spending roughly US $150 billion a year in the 65 countries that have signed up to the scheme, with up to $5 trillion expected to be invested. BRI projects already stretch widely across Asia, from Bangladesh to Belarus. We've got railways, refineries, bridges, industrial parks, and much else being built. A new city is taking shape in Colombo, near Sri Lanka's main port. The total investment in this is estimated at $13 billion, spanning 25 years. China Merchants Port Holdings Company, which is a Chinese government majority-owned listed port operator, owns the Colombo port and is backing a much-needed second terminal. A freight route linking China's east coast and London has already commenced operation. Stretching over 12,000 kilometres and passing through 9 countries, the railway allows cargo to travel across the Eurasia continent in less than 20 days. Ultimately, we believe the BRI reinforces and will be reinforced by the two major investment themes already playing out across Asia. One, the global need for renewed infrastructure investment aligns with the BRI objective. And 2, the emerging middle class as discussed today. The BRI will only reinforce and accelerate that trend by generating wealth more rapidly. So where are we? The Chinese government has stated the BRI is not a strategic initiative, although it will help secure resources for future generations, and that it does not represent a form of alliance. However, the BRI may well lead to a seismic shift in the balance of global economic and hence political power between East and West. At a time when a Trump administration in the US is forging a Make America Great Again or Fortress USA foreign policy, ripping up the Trans-Pacific Partnership Free Trade Agreement, revisiting the North American Free Trade Agreement, and building walls with Mexico, the Chinese government under President Xi is heading in exactly the opposite direction. China is actively seeking to be recognized as the world's leading advocate for free and open trade, a long-held position for the US, but one which they now appear to be vacating. Even though China states that the BRI has no strategic goal, with economic influence clearly comes global political power. In recent times, all has gone quiet as Xi Jinping looks to complete trade talks without highlighting their global expansion. Once the trade deal has been done, we would expect the Belt and Road Initiative to be back on the table. The BRI will involve a huge amount of infrastructure spending, which will create investment opportunities for those willing to capitalize. The BRI will happen with or without American involvement, and it will reshape Asia. So to wrap up today's webinar, I believe infrastructure offers a number of compelling investment characteristics, coupled with a strong ongoing need for significant infrastructure investment across the globe, which means that global listed infrastructure is a product for all markets, including 2020, and will offer superior returns for decades to come if actively managed to capture the structural and cyclical opportunity set, with the emerging markets being integral to that opportunity set. Thank you very much.
Thanks, Sarah. Really fascinating look there at how these emerging regions are transforming and the role infrastructure will play and what it means for investors, especially here in Australia. We'll jump into some questions now. Just a reminder that you can ask your own question to Sarah via the taskbar to your right. There's a little question panel. Just type it in there and we will endeavour to get through as many as we can. We just to start, we got one here. Just a listener just wanted some clarification. How do you define the emerging middle class?
Define it. So it's basically that shift in wealth. So look, we have a significant shift coming from people out of what is considered poverty. Now, how do you measure poverty? There's been a number of metrics around poverty, and it's generally a PPP adjusted metric. So it's that shift out of those poverty levels and just moving up, and it's an expansion, as I mentioned, to 3 meals a day, and then it's actually getting power and clean water and indoor plumbing and the access to what we would consider basic essential services, and it progresses over time. So the band of the middle class is quite large, and it's a evolution that will happen over many years. But it's really coming down to, I guess, simply getting the access to the basic services that we would consider just a normal part of everyday living.
Yeah, great. Hope that answers your question there. We've got a question from Roger, just wondering if you don't mind comment on corruption in emerging markets and the effects this could potentially have on the infrastructure and the returns.
Yeah, look, I think it's a great question, and I think if you saw the the risks in investing in emerging markets, corruption is clearly key as a risk. What I would just say, just clarify there, is that corruption is not constrained to emerging markets. It's a global phenomenon, unfortunately. And look, it's something that we monitor very closely. We do country reviews on every country that we look at. We look at things like financial risk, economic risk, political risk, ESG elements, which include clearly corruption. We're looking at it from a government level as well as a corporate level. And it comes back to that comment I made about infrastructure is really being confident in the strength of the judiciary and the actual within a country. And that's, again, why I mentioned Brazil. So Brazil would be considered to be going through a huge corruption scandal, and it is. There's no question, huge corruption scandal. It's called the car wash scandal because it started in a car wash, and it's now, and it's about its 55th iteration. And the Brazilian prison system looks like the who's who of economic superpowers of Brazil. We've got 2 presidents in there. We've got most of the CEOs and CFOs of large Brazilian corporates in there. And that is because the judiciary will not leave the corruption alone. They're saying we're cleaning up corruption once and for all. Now, is it going to be perfect? No. But there's what I would say from an emerging market perspective is the corruption perception index, which there's an index. The emerging markets are improving. They're still weak, but they're improving. While in the developed markets, the corruption perception is deteriorating. Now, corruption perception also goes hands in hand with economic development. So as the emerging markets continue to evolve economically, the perception of corruption in those underlying countries tends to dissipate as well. So it's a work in progress, but what we're looking at from an emerging market perspective is that we are seeing improvements. We are looking at the strength of the judiciary, and we're looking at companies in that who have higher levels of corporate governments and etc. When we're looking to invest there.
Right. You mentioned there that you sort of analyze every country.
Yes.
We obviously know China, India, Indonesia. Looks like the country's really taking off.
Yep.
Is there any other that you're sort of keeping a close eye on, or you think could be really an emerging superpower? Yeah,
look, I think you mentioned one there, and it's one that doesn't get a lot of talk is Indonesia. Indonesia is in, well, particularly from an infrastructure perspective, Indonesia is in a very strong economic position. It's certainly shifted from its economic weakness of decades before. It's got a very strong government under Widodo, who's got a great deal of popularity, and he's investing heavily in infrastructure. And he's cleaned up the system of infrastructure capital deployment to really entice private sector capital to invest in infrastructure. So it is actually becoming a little bit of a poster child for infrastructure investment and the support of the government in an emerging market to get it done. So yes, we definitely think Indonesia looks attractive. There's limited investment opportunity within the listed space at the moment, but we're certainly capitalizing on what is available. We also still think that, the China evolution is there, India is there, Vietnam's looking really strong on that side of things, but again, we have to get more confident in the strength of the judiciary and the structure of their regulatory environments, and the assets must come to the listed market. And even in Latin America, where we're sort of perceived to have a little bit more, there's a little more higher levels of corruption, Mexico is a big beneficiary of the emergence of the middle class. Brazil is a big beneficiary of the emergence of the middle class, as well as the government's goal to see a lot more infrastructure asset make it into private hands.
Awesome. Another question here. Is there much US dollar denominated debt in emerging markets, and how will this influence markets going forward?
Yeah, look, that's a really good question, and it's why that they expected emerging markets to have to increase their rates last year when the US Fed increased theirs. So historically what had happened was the emerging markets were holding a great deal of US dollar denominated debt. So when the USD increased their interest rates, it became more expensive for them to hold and service that debt. So they were effectively forced into increasing their own rates to keep that debt or that dollar exposure in balance. Interestingly, last year that was not the position of the majority of the emerging markets. Now, there were 2 that were clearly still had a great deal of USD dollar exposure, and we saw what happened there. And one was Turkey, and the other was Argentina. Argentina's fragile fiscal and financial position was not strong enough to withstand the US Fed rate hikes. But countries like Indonesia, who have rapidly rapidly reduced their USD exposure, and actually probably are a net net long USD now, are basically in a much better position than they were historically, and that's true of the majority of the emerging markets.
Great. Another question. Just wanted your comments around the debt diplomacy promoted by China.
Debt diplomacy.
Debt diplomacy, yeah.
I'm not sure I understand the question there, but is that around?
It's a bit more, yeah. What about debt diplomacy promoted by China and its pernicious damage to sovereignty in emerging markets? No.
I'm not sure if you're talking about where the debt is held. So if it's the local, provincial, or the federal level, and how they're shuffling debt around there and opening up credit marks. I'm sorry, I'm not sure.
That's okay. We'll move on to the next one. I think you may have covered in the presentation, but apart from the government stopping spending, what is infrastructure's worst macro enemy?
And again, this comes down to that. This comes down to the two distinct subsectors within infrastructure. So, look, the biggest enemy to regulated utilities in a short term is interest rates going up. So, because regulated utilities returns are measured independent of volumes, and in a lot of cases, the returns are dictated based on the starting point is an interest rate at a point in time, and there's a 4, 5, 3-year sort of cycle. If interest rates go up in that cycle, then your returns will be squeezed in that cycle. However, at the reset, then you will see that reversion and improvement in your return cycle. But regulated utilities are your bond proxy within a interest rate rising environment, and that's probably their biggest squeeze to returns within a cycle. However, on the user pay side, which is the economically different side of the infrastructure spectrum, they are correlated to GDP and inflation. So GDP growth will drive your volumes in a lot of your user pay assets, and inflation will drive your tariffs. So if you're in a situation where we've got a negative GDP growth or deflationary environment, that is going to hit your earnings profile. So this is where you actively manage between those two subsectors within infrastructure to capitalize both in country and at a global level of where we're sitting in the economic cycle.
Great. You also mentioned in the presentation that there's been a lot of energy conversion, specifically from coal to gas. So are you seeing coal being slowly reduced or phased down in these markets?
Yeah, look, this is a very regional dichotomy. So definitely in Europe, coal is disappearing, and they've got very strong renewable targets and net carbon neutral targets. So sort of in the emerging markets, that is sort of a slower transition. Now, so China definitely has coal to gas conversion targets. So they're the largest coal-fired generation producer in the world, but they're also the largest renewable country in the world as well, and that's just really a function of their size. However, they do have a target to get to a generation mix of 10% gas. And it's only sort of 6 or 7% now. So, they're really trying to move forward to that cast, but coal is still going to be around in places like China, and even with India with its renewable targets and it's actually great renewable resources, coal is still going to be a base load there for a number of years. So it's definitely a transition. It's just the speed that coal will disappear over time. It will go to gas first because we still need a base load factor because renewable has an intermittency issue. But if we get batteries that work better, then that could also change as well. So there's definitely a move to renewables. Europe will get a much closer to 100% renewable profile or renewables and gas profile a lot faster than, say, Australia will, the emerging or China or India will. Somewhere like Brazil's already 75% hydro, so they're much further down that path.
Yeah, right. And you mentioned the China One Belt policy. Is there any other projects that are going on around the world that really excite you at the moment? So
I think it's really so China's a global project. The One Belt One Road is a global project. I think where we really see exciting projects internally is in-country infrastructure projects. So again, we saw Indonesia's got a very large infrastructure program. We have Brazil with a significant infrastructure program. We have, and in their case, they're wanting a lot of assets to come to the market. We have Trump's promised $1 trillion infrastructure investment program. I'd like to get excited about that, but we've seen no movement forward with that for the last his first term in office. So there's definite programs that support infrastructure build-outs. It's just they're more in-country as opposed to One Belt One Road is really a global scale infrastructure program. And that One Belt One Road is also supporting countries that could not fund their own infrastructure development, get that infrastructure in place, which will enable them to evolve and get a middle class much faster than if they were left on their own devices.
Great, and we'll just wrap up. We had a couple of questions here about 4D. So we asked, do you mind sharing how much funds you have under management and what is your competitive niche in gaining access to infrastructure assets?
Yeah, look, I'll start with the competitive niche. So our competitive niche, I believe, in terms of listed infrastructure, is that we are truly global. A lot of our peers don't take a strong focus or look at emerging markets. So we do include that emerging markets in our opportunity set, and at the moment 35% of my portfolio is in emerging markets. So there's that. Secondly, is just being completely and utterly index unaware. I don't want to give you the relatively best ideas globally. I want to give you the best ideas globally. And that means very strong active management. If you looked at my portfolio today, it would be at least 60% off index, and that's because we're taking active positions between user pays and regulated utilities. So that's, again, we are really active between those two subsectors. And third, we brought economics in-house. So a lot of people talk about having a macro overlay. We've integrated economics into our process because hopefully you've seen today it's an important element to infrastructure investment. So my business partner, Greg Kudsell, spends his entire time on economics and strategy, entire time looking at these countries, reviewing their judicial systems, reviewing their corruption, reviewing their wealth equality or inequality, which we're seeing, spike up in Chile at the moment. So I think that's where we really try to differentiate ourselves. We're still relatively small, just to follow on the second question. We have about $70 million dollars in assets under management at the moment, which is all retail money. We have got a 3.5-year track record and clearly gaining quite a bit of momentum at the moment. And what I would say, though, in terms of performance and size, is that we have a screening process within our universe construction, which strips out small companies. So our portfolio will be the same today as it would be if we were 5 or 6 billion or 7 or 8 billion. We are not capitalizing on small companies to try and add alpha at the moment because we don't want to change our performance profile as we grow. Okay,
fantastic. Hope that answers your questions there. We're going to wrap it up. Apologies if we didn't get to your question today. Sarah, thank you for joining us. Audience, thank you for tuning in. We hope you enjoyed this session. Just to finish off, a couple of reminders, advisors, there is a CPD point available. If you're online for more than 30 minutes, you'll receive the information to claim your points via email in the next week. Also in that email, and for everyone else, you will receive a copy of today's recording and some of the slides, and we'll also include that link to the white paper on China's One Belt policy that you'll receive in that email too. You may also be interested in our Compare Funds and Models page, which allows you to compare over 400 managed funds and models and their performance on our platform, including the 4D Global Infrastructure Fund, which Sarah manages and mentioned today. You can view that by visiting our Compare Funds and Models page, which can be found on our website under the Personal tab, then Research and Tools, or if you're logged in, it's just under Forms and Research. And we've also got a portfolio construction podcast series in which you can hear about more insights from some investment experts. We also support financial literacy in schools through Banker. I know school's coming to an end, but it's worthwhile looking into getting it for your kids' school next year. We sponsor 15,000 kids, and it teaches them everything about budgeting, savings, interest rates, rent, superannuation, all the skills that I know I certainly wish I had learned in school. And it's absolutely free on ours. So go to our website and find out how you can refer a teacher today. Finally, thank you again for joining us. We look forward to seeing you at our next investment webinar in a month's time. Hope you have a great day. Thank you.